Good afternoon, everyone, and welcome to today's webinar, Infrastructure, Ships, and AI, a Diversified Approach. My name is Nafis Sibai, and I'm excited to be your host today. Before we dive in, I just want to take a moment to thank all of you for being here. Whether you're joining from us from the East Coast or the West Coast or somewhere in between, we truly appreciate your time and interest. Let me tell you, we've got a great session lined up today with some fantastic guests joining us. And just a quick reminder, we'll have a Q&A at the end, so feel free to drop your questions into the chat at any point. Why we're here today, there is no doubt AI is reshaping the world around us. Yet, while most conversations focus on what AI can create or automate, there is a massive ecosystem working quietly behind the scenes. Power infrastructure, data centers, semiconductors, and critical raw materials. And these are the essential building blocks making AI possible. And that's the idea. That's the rationale behind the launch of the Global X Artificial Intelligence Infrastructure Index ETF Matrix. Has nothing to do with the movie Matrix, by the way, and no, Keanu Reeves is not involved in this. But I can tell you, our matrix does offer a real-world exposure to the infrastructure powering AI, like energy, data centers, and essential materials like copper and uranium. AI is growing fast, and the things that make it possible are just as important. And that's exactly what we want to talk about today. We will discuss the latest AI market trends, from DeepSeek, NVIDIA to tariffs and policy shifts. We'll also discuss the infrastructure and raw materials fueling AI's growth. We'll also talk about how semiconductors fit into the AI investment landscape. And joining me today are two fantastic guests who bring a wealth of knowledge and expertise. That's me, obviously. So my first guest is Scott. Scott is the head of investment strategy at Global X US. Scott brings deep insight into AI trends, macro strategy, and global markets. Prior to joining Global X, he held leadership roles at BNY Mellon and Morgan Stanley, where he focused on economic research and disruptive technology. Scott, always great to have you with us. Thanks for joining.
Thanks for having me.
My second guest is Alex Matin, portfolio manager here at Global X. Alex specializes in ETF strategy, capital markets, and thematic investing, with a strong focus on artificial intelligence. Before joining Global X, he worked at BMO, Global Asset Management, helping to develop innovative ETF solutions. Thanks for joining, my friend.
Thank you for having me.
We've got a lot to cover today, gentlemen, so let's get started. We can go to the next slide. So Scott, let me begin with you. So it's only the first quarter of 2025, and wow, we're already getting a taste of the volatility many expected between the DeepSeek launch, sudden tariff announcements, spending freezes, shifting sentiments, you name it. Investors have been hit with surprises from all directions. I mean, to help me set the stage, Scott, set the stage for our conversation today, I want you to help us make sense of all of this. What's happening? What's going on? And what should investors be watching right now? And how do they stay grounded in such volatile environment?
Well, Nefis, I'm not sure that I can accomplish all of that. That is a tall order to make sense of all of this. But the moral of the story is that the secular technology trends that have driven the economy and led to, quite honestly, a period of U.S. exceptionalism where the United States has delivered the fastest GDP growth of any of the G7 countries since the end of COVID. That is not a politically driven outcome. That is driven by technology and it's driven by smart investment. And so that's what I think we should continue to focus on. Let's jump ahead for one slide here, and really kind of try and get into this. And we're trying to reason with high vol season. That's where we're at. And so the good news is that Jimmy Buffett is a calming influence for many around the world. And so we're going to invoke a little bit of Jimmy Buffett, and we got some deep seek in the water. But we've had both a series of news announcements and economic reversals that have thrown markets a curveball. So if we just take a step back and we look at DeepSeek for a minute, and we'll talk about tariffs because obviously that's an important issue in US-Canada relations right now. But if we just take a step back at DeepSeek, really what I think it was a revelation for people who said, I own Microsoft and I own NVIDIA, so I'm covered with AI because I've got my chat GPT and I've got my GPU exposure, and that's perfectly okay. Well, perhaps it's not, because this is an evolving technological landscape. And DeepSeek's innovation, which, by the way, I think a lot of people would say the very quick rollouts that came from ChatGPT and from Grok, potentially even from Gemini, from Google, right? So that's, effectively OpenAI plus Microsoft, that's Twitter, and that's Google. Those changes that they made, incorporating some of the technology that came out with DeepSeek, was very, very rapid. So what really challenged the market with DeepSeek was the assertion that it was trained on 2 generational old NVIDIA chips at $6.5 billion. I think that's largely been defunct at this point. I think it's pretty clear that their startup costs were higher and that they probably co-opted some of the code, which, quite frankly, now people are co-opting some of their code because there's two pieces of this. There's training and there's inference. And so in the United States, a lot of money was put behind training in order to provide a very targeted data set and then ultimately reduce the requirement on inference. What DeepSeek did was they said, okay, we can do less in the training piece, of course, probably co-opting a little bit, but we're going to do more in inference. And so we're going to let it ask itself questions rather than have people ask it questions. So in the end, I think it was just a wake up that the AI ecosystem is so much bigger than what people were originally thinking, right? And it's that hardware, software, and data. And broadly, I think you want to be exposed to all of it. And that's the secular trend that's going to continue to drive growth in the US and elsewhere. But let's take a step back because you asked the loaded question about tariffs. So let's push forward a slide. And, tariffs are tricky because when you look at periods of increased tariffs, generally speaking, things go up. GDP numbers go up. Consumer spending goes up, but it's because people are paying higher prices. Where we do see some effect, and what we're focused on right now, is on the household level, because those are the people that ultimately have to take the brunt. And historically, we see real incomes in periods of tariffs go down because the prices that they pay go up, and we see borrowing go up in order for people to continue living at their current standards. So let's push forward one more. From a net effect, though, in the US, we could potentially offset the cost of these tariffs, because really what do tariffs do? They move money to the inefficient sector, we'll just call that government, from the private sector, which is the efficient sector, that's better about choosing what they invest in and how they use their money. So we can offset that in the US by lowering taxes, which is what the proposal is. And it's roughly about the 1 percentage point that we would need to offset, call it a mid-level of tariffs that the US is going to impose. So all that to say, we could potentially offset. However, let's jump forward one more slide. I think nobody expected, including us, and we talked about, for example, policy sequencing as a really big risk to start the year. No one expected the extent to which this administration was willing to damage the economy to get it on a different footing. And so just in the past couple months, we've seen what had been higher trending consumer confidence, higher trending small business optimism, and higher trending bullishness in the market. We've seen all of those metrics roll over. And I think that that's trying to absorb the fact that the people running the Trump administration, the White House in the US, really do have a belief that we need to hit a reset button on the economy. And while I'm not sure that I feel that way, because I think the private sector has been tremendously efficient, we're going to have to live through a period where they're going to attempt some things that are unconventional. Let's jump forward another slide. So one of the things that I want people to remember as we talk about this is the sentiment, or I would say the reaction that people have to high volatility is to do things like short-term treasury and cash. But we now offer a whole range of investment vehicles that can help lower beta, lower the risk of your portfolio without necessarily having to go flee into those low return areas. And that's really important. So you look at something like digital infrastructure, as you were talking about with Matrix, and that's something, or infrastructure development. Those are things that are lower beta to the market. Or you can look at something like AI, and that's roughly running about a beta of 1 with better fundamentals. So we now have these tools that I think people associate with disruptive technology and growth, but they're actually capable of changing the way people balance risk and return in their portfolio. Let's jump forward one more. So the two areas that we really focused on in terms of potentially driving above trend growth in the US were not just mega cap spending, though we'll talk about that for a minute. Mega cap spending was super important last year, over $200 billion in CapEx. But what we're hoping for is a return of small cap investing. But let's be very clear about why mega cap is investing. It's because AI is disrupting their own platforms. So if you think of the Mag 7 and who they are, it's Apple, which provided for 20 years through the iPhone our access to the information age and the internet. It was Google who helped us find the information we wanted. It was Microsoft who had a content creation program for us to all use Office. And it was Meta that allowed us to share it with each other, right? And then when we took some time off, we all hit Netflix for a while. So what those guys are saying effectively in their investment behavior is that AI is disrupting the very platforms that made them successful, and now they are investing in data centers and AI platforms to be ready for the next iteration. So let's jump forward. In the US, right, what we're trying, so the first thing we're looking for is continued investment from mega cap and the beginning of investment from smaller cap companies and mid cap companies into the space. The other area that drove our optimism to start the year is the return of manufacturing, and that gets to the tariffs, which is a very sticky issue between obviously the US and Canada. People thought that the USMCA renegotiation, US-Mexico-Canada agreement, was going to be a 2026 issue, but it's really not. Because if the administration was going to impose tariffs, it had to happen this year. How the Trump administration managed to be the ones negotiating twice in a row over a decade-long period is sort of remarkable. But it's pretty clear that the last time that they imposed tariffs, it did jumpstart U.S. new orders out of really a decade of stasis, decade and a half of stasis. And that's what they're trying to do again. And you've heard Scott Bessent, Treasury Secretary, you've heard Howard Lutnick talk about it from Commerce. That's what they're thinking about. So I'm not sure if I can say that I can solve it, but what I will say is I wouldn't bet against the US economy. I wouldn't bet against the secular trends. I would bet on areas like artificial intelligence, digital infrastructure, physical infrastructure as areas that are going to be critical to both the US and Canadian economy.
Great. I mean, that was a great overview, Scott. And I like how you said, in fact, how fast moving developments, whether in AI, in policy, or market sentiment, are creating both uncertainty but also opportunity in the market. That was great. So we got a lot of questions, Scott. We'll come back to that, and we'll come back to a lot of stuff you covered already. But now that we have looked at the big picture, let's shift our focus to what's powering AI behind the scenes. Alex, over to you, and let me ask you this. From your perspective, Alex, why it's so important for investors to pay attention to the physical inputs of AI, and how does Matrix capture that opportunity? And we can move to the next slide, please.
Sure thing. Thank you, Nafis. So ultimately, the way an easy way to think about the AI value chain for the average investor would be, well, kind of like Scott mentioned, like I've got my Microsoft and I've got my NVIDIA, so I've got my hardware and I've got my my software, if you will, my input and the output. But it is a lot deeper than that, naturally. The actual amount of industries and companies and just sheer amount of resources involved in actually making AI a reality, and the very same AI models and applications that we know and love now is incredible. There's a ton that goes into it. So with that in mind, if we could go to the next slide, Matrix or the Global X Artificial Intelligence Infrastructure Index ETF ultimately gives you a snapshot to some degree of what this looks like, and it's in my mind a great way to visualize the inputs that go behind the outputs that we've become so accustomed to now. I think that everybody typically does think about the outputs when they're thinking about AI, and that's very reasonable. But to your point, there's a lot of physical infrastructure involved as well. So in a way, we'd liken this to a picks and shovels approach to investing in AI. You still get exposure to the overall theme and to that secular trend that Scott was talking about, but you're not necessarily just doubling down on your Mag 7 exposure, because again, the movement's a lot bigger than just the Mag 7. So even from an industry breakdown in just this call it pocket of AI, we've got industrials, utilities, materials, energy on top of the information technology as well. And it's really backed by a fundamental thesis that where we believe that ultimately there's going to be a significant amount of investment beyond what's already been invested into both the electrification of our society, but also into just the infrastructure that goes into making AI models and applications possible. A lot of that's obviously going to be concentrated in things like data centers, but nonetheless, there's still a lot of inputs that go into the data centers, which are, if you want to call them that, the inputs to the very same AI models that I've been coming back to. So the way that we break it out within this picks and shovels approach is by breaking it out into three pillars. So those three pillars, if you just go to the next slide, those three pillars are the power and energy infrastructure. This would be referring to the companies that play a key role in energy infrastructure, so supporting data centers by optimizing energy distribution, storage, and transmission efficiency. Then there's raw data center infrastructure, which is more in reference to the actual creation and maintenance of data centers. So supplying things like the essential equipment and thermal management solutions that data centers require just to exist. And then raw materials and energy source, almost self-explanatory, but really this is just about the companies that are actively engaged in the mining and refining of raw materials or even supplying energy sources. Functionally, it's critical to the other two pillars that I've mentioned. In the case of Matrix specifically, we're focused on copper and uranium, and I'll come back to why we do that, or why the index does in just a second. So I'm not going to spend a ton of time on each pillar, but I did want to just dive a little bit deeper. So if we, on the next slide here, So on the electrical utilities, energy management, and infrastructure side, we've got companies like the Eaton Corporation, companies like Siemens. Just to make things a little bit interesting here, what I've done is I've included companies and their weight in the portfolio. And you might have noticed on the first slide of Matrix that we cap them at about 5%, or the index does. While I can spend more time on the individual companies, what I'd really like to do here is just to list them so that people are aware of just the variety of players that are involved in the space, just to give a bit of a snapshot and an understanding as to just quite how varied even the inputs in the artificial intelligence space are. And really, the reason here, it's just a defense of why this sub-theme within the inputs is so important. And it ties back to that electrification point that I mentioned earlier, where ultimately these AI models and AI applications, they take a significant amount of just raw power in order to actually both build them, train them, and to then run inference. And so you're going to require an electrification of our overall society, and an improvement in our electrical grids, and an improvement in the actual distribution and generation of energy. And that's where companies in this pillar really come in. They assist with things like power transmission and distribution in the case of Siemens, or in the creation of circuit breakers for Eaton. All that just to highlight some of the examples of the little bits that you might not necessarily think about when you are investing in AI. So on the next slide, I go into the raw materials and energy source one. So I think this one is going to be of particular interest to a lot of people, because it's a very key theme that has only really picked up a lot of pace or a lot of interest in the last year. And like I mentioned, we're more focused on copper and uranium. So copper might be a little bit more self-explanatory, because it's naturally it's a mineral that ultimately goes into all of the circuitry, all of the cooling systems that are found in data centers, but also in things like cell towers that are still part of that network that is required for the delivery of AI as well. But then uranium, on the more esoteric side of things here, is the reason we included, or the reason we're focused on it, is because there's, call it, two tasks to solve. Ultimately, there's the task of just raw energy generation. We actively just have an increasing demand for energy coming from the AI industry, as well as from things like EVs. Then on top of that, a variety of developed economies still have net zero goals that they have to meet. And so there's this question mark of how are we supposed to meet net zero goals while still meeting this demand of energy, especially as more economies become more developed and advanced, and more infrastructures built even outside of AI. And an answer that we repeatedly come back to is uranium. And coming back into AI, a variety of tech companies are actually simply buying nuclear reactors in order to assist with that power generation. It answers that question ultimately. And so that's sort of why we come back to uranium, even if it might seem more esoteric, as well as copper. And just names that are involved there is Ivanhoe and Cameco. And then this chart that I included here, again, I don't want to spend too much time, but just to highlight, coming back to the copper bit, there has been a copper deficit from a supply perspective, and especially as the growth of demand for data centers and for the density of data centers increases. There's potential for that demand to simply outstrip the amount of supply that's available, and for that deficit to grow. That has a potential to be beneficial for both copper as a whole, but also for copper miners potentially as well. Then moving along into the third sub-theme. So data center infrastructure. This one is more explicit in nature, because this is the one, of course, focused on the this one's more focused on the actual maintenance and creation of data centers. So some names in here might even be more familiar, like supermicrocomputers, one of NVIDIA's largest clients. And then this chart here on the right, I've included just to highlight again, coming back to that same point of just the amount of the increase in demand for both data centers, and then the density of those data centers will contribute to just the increase in players involved, both in the infrastructure space, but then also in the little nitty gritty things that go into that infrastructure space. So in the case of data center infrastructure, like I mentioned, we've got super microcomputer, but we've also got more, let's call them niche names that you might not be familiar with, like Nidec. It's a Japanese manufacturer and distributor of electric motors, but they are, funnily enough, they've got the largest global market share for that tiny spindle that goes into tiny spindle motor that goes into hard disk drives. Naturally, you have data centers that require a significant amount of storage, especially when we're training AI models. And so that's obviously going to be a very key part of the process as well. And then again, like I mentioned, there's companies like Trane, which are more focused on the heating, ventilation, and the HVAC systems and refrigeration systems that go into data centers as well. All this to highlight that there's this huge variety in just the players that are in the space all along the value chain. I've only been talking about the inputs within AI so far. I haven't even mentioned like just the chip manufacturers.
Absolutely. Before we move on to the chips side also, just I want to comment on this graph. That's pretty fascinating, Alex. So I see around 2022, the demand was just under 20 gigawatt, right? This is what I saw. And in 2023, this is expected to hit around 35, which is kind of 75% increase. Just for our audience to understand and to put things in context, I mean, 1 gigawatt can supply the electricity of approximately 750,000 to 876,000 homes annually. So an increase of 15 gigawatts, it's a big deal actually.
It's huge. It's huge. There's a reason that tech companies are buying up nuclear reactors. It's things like this. It's ultimately like it's examples just like that. When Google bought a handful of SMRs, like that's exactly what they're trying to solve for. It's the data centers themselves already, even without AI, just churn through a significant amount of energy. But then you toss on AI models and AI applications that are being developed by these data centers, and then suddenly, that growth is almost exponential.
Excellent. Thanks, Alex. That was a great breakdown of the infrastructure and raw materials driving AI growth. And of course, all the infrastructure needs one key ingredient to bring AI to life, and that's its semiconductors. So let's go to the next slide and let's talk about chips. Our ETF that gives investors exposure to global chip makers powering the AI revolution.
Sure thing. So I've spent a little bit of time here now talking about matrix and about, let's call it the inputs, the picks and shovels. For those more familiar with energy companies and the energy industry, the inputs in the AI space let's call them the upstream companies. And then the outputs, like the Mag 7 and whatnot, that'd be more the outputs. That's the outputs, that's the downstream. Chips, or where chips sits, and semiconductors in general, let's call them midstream. It's like right there in the middle of that sandwich. And ultimately, it comes back again to that same theme. As AI models become more advanced, as the computing power required for them increases, and as the density of data centers increases, there's naturally this forecast that we end up building of an increased demand for data centers across the board. And what goes into those data centers, apart from all the things I've already described, it's chips. And so what chips does, or CHPS in our case, what the Global X Artificial Intelligence Semiconductor Index ETF does is it gives you access to that midstream, to that little bit in the middle there, where ultimately, we're further down the value chain. But again, you've got some companies here that are a little bit more familiar, things like Broadcom, NVIDIA, Taiwan Semiconductor. It's all that I'm really trying to do here is just highlight quite how varied and broad the AI industry is outside of just, NVIDIA and Microsoft. I'm simply echoing kind of what Scott mentioned earlier, is that there are so many players in the space, and picking winners is already hard in just the outputs. But once you incorporate the fact that there's a whole slew of industries in just the inputs, it's a secular trend that's, it's not really showing signs of significantly slowing down.
Absolutely. I mean, there is one more piece that I would like to touch on, the companies actually applying AI across industries like healthcare, automation, or finance. And that's where AIGO comes in. It's our ETF also that designed to give investors a diversified exposure to the outputs of AI, like you said, while keeping a cap or a limit on mega cap names to avoid over concentration. Let me go back to Scott here. Can you, Scott, tell us a little bit more about AIGO and how it fits in the broader AI story we've been exploring today?
This has been a very popular theme this year since DeepSeek came out. And from our perspective, owning the Mag 7 is a really important part of the portfolio, but you own it everywhere. Let's say you own a sector ETF for the US. Well, you own if you own the tech sector or the consumer discretionary sector, you own a really big portion, right? You're running like 30, 40%. Let's say you have a large cap active growth manager, right? They're probably hugging the benchmark a little bit. They're running about 30, 40%. For the record, most of us, I would imagine, also own these as individual names in our portfolios. So we kind of own them everywhere. And the way that the AI fund is designed is it's actually where you can go for that other exposure. There's 85 companies in the portfolio. And what we do is we cap them twice a year at 3%. And so these are the people that aren't necessarily just providing the background, which is super important, but they're providing the actual software services. And that's bigger than the Mag 7, right? It's Workday, it's ServiceNow, it's Salesforce. It's a whole series of companies that, quite frankly, are empowered to be providing better services. And so by capping at 3%, right, means twice a year, we're resetting that Mag 7 number down to 18%, and you're getting 82% into the rest of the AI as service universe. And so that to me is a very powerful proposition because it's where people are not positioned right now. So I'll leave it there, Nefis, and see if there are any other questions.
Absolutely, that was great. Let's quickly recap here what we covered today. So we have matrix for exposure to the infrastructure and raw materials enabling AI. We talked about AIGO for a balanced approach to the companies implementing AI. And we also talked about chips for direct exposure to the semiconductors powering AI's evolution. And for our attendees, if you're interested in related themes, keep an eye on ETFs also like TTTX, RBOT, COP, and Uranium, all exploring key technologies linked to the AI ecosystem. And you can explore all these products by visiting our website, globalx.ca. Now let's move into our Q&A session. Thank you to everyone who submitted questions. Some great ones came in from across the country, so let's jump in. I got a question here from Philip in Ontario. I think this one is for you, Scott. What kind of impact do you see AI having on the wealth management industry? Is it a risk, a tool, or both?
So I get that question a lot. And rather than just say risk or tool, whenever people are queried, surveyed about what they look for in a wealth advisor, pretty much the first thing is trust. Investment performance, to my chagrin, is usually like number 8. So for an investment strategist, that's like a tough pill to, right? It's kind of like the day you realize you're A, never going to beat tax alpha, and B, you're never going to be a professional baseball player. So trust is really kind of first and foremost in the industry. And up until we get to the point that we trust our algorithms more than we trust people. Look, I fly Delta a lot. I use the Delta app. It's gotten really, really good. But when my flight to LA gets delayed because of air traffic control issues and I need to get to Australia and I'm going to miss my plane, I call up and I talk to somebody. And so at the end of the day, that's what people want in their wealth manager. They want somebody who is looking after them. Relationships matter. And so I think that AI can do a lot in the back office. We're exploring a lot of things around trade settlement and
Yeah,
compliance, the parts of the business we don't love. And so that's where I think it's going to impact first. And that wealth management relationship, I think, is going to stay intact for quite some time.
that's a great answer. So let's take another question from John in BC. Can an AI ETF really separate itself from the big tech names? Or is some overlap with the Magnificent Seven just unavoidable? And if so, what's the case for buying a thematic ETF? I think, Scott, maybe you can speak to the 3% cap in AIGO and how that help address this concern.
Yeah, so I don't think we don't want to ignore the Magnificent Seven and the mega cap because they are investing in building that infrastructure that's going to be so critical. However, they're not the only people that are going to benefit. And the risk that I think we put on when we just focus on the Magnificent Seven is utilities are great at throwing out cash flow, traditional utilities. They're not great at growing the top line. And so it's getting harder and harder for these ginormous guys to be able to grow sales as quick. But if you look at something like AIQ, where you cap it and you provide exposure into that, smaller, large, and mid cap space to players like that, you do get a makeup that, for example, is supposed to grow their top line faster than the S&P, right? It's supposed to grow at around 10%, whereas the S&P is going to grow at probably 5 over the next couple of years. And it's delivering superior margins, where the S&P is at 12, 13, which is phenomenal performance. But the AI guys, right, in the small and mid cap are going to probably deliver 14 to 16% profit margins. So I think you can have this more balanced approach, and ultimately, so far it's working really well, and I think it probably does so in the future.
Yeah, absolutely. So we got another question from Armando from Ontario as well. And I think this one is for you, Alex. What could derail the AI and infrastructure growth thesis? Are there any major risks that investors should keep in mind?
Sure. So I think this is actually one that I like. I think Scott and I can both answer in a back and forth way here. Like, I think some of the things that I've paid a lot of attention to, in particular, has been just there's a couple of realities here, and first and foremost is that AI as a theme is subject to the same near-term uncertainty that the rest of the market is subject to. All of this tariff uncertainty, it can and has put pressure on some of the names that are in these indices. That's just a reality of the uncertainty that we're facing in the market, and that's okay. That's part of the game. But beyond that, some headwinds that might may or may not materialize, or sorry, maybe materialize is the wrong way to put it, but some headwinds that the space may be facing as well is that ultimately data centers are capex heavy. Costs are rising. It costs a lot to build and maintain these. Vacancy rates are incredibly low, and there are some supply chain issues along the way. Like, some of these very same pieces of equipment that go into these data centers are experiencing shortages. And so how that evens out over time will remain to be seen, but they're real headwinds that the space may face and continues to face. But it is still a secular trend that has potential to grow well into the future. Scott, I'm sure you've got something to add there as well.
Yeah, I think that, Alex, those are all great points. The thing that I would probably toss on top is regulation, and we're going to have to see how government wants to handle this. I mean, clearly the technology is developing, and there could be both technology hurdles and there could be supply chain hurdles, as you identify. But The government keeps kind of dipping its toe in the water, and we have to see the extent to which they're comfortable with mega cap tech continuing to operate as they have. Right? Even the Trump administration has talked about potentially, looking into Microsoft and their dominance. Obviously, in Europe, Google has gotten a lot of attention. So I would just keep an eye on that. The flip side is this is nothing new for the industry. There's entire think tanks that are devoted, and dozens of universities to the ethics and the legality and the rollout of AI. So just worth paying attention to.
That's great stuff. Thank you, guys. We'll finish with this question. I'm just curious to hear your thoughts on that one from Sean from Ontario. So he said, Canada is rich in minerals and key resources. Could it play a bigger role globally when it comes to supplying innovation and technology?
Yes.
Yes.
The short answer is yes. The slightly longer answer is that it absolutely has the potential to, and has every, I believe, ability to. But it'll be a function of the incoming administration and the type of investment that is put into infrastructure, as well as into trading relationships. I mean, those have been put into question more recently as well. The short answer is yes. The slightly longer answer is that it will depend on the actions of the incoming administration.
Scott, anything to add?
Completely agree with Alex. I mean, Canada is long on resources, and in the United States, our uranium fund, Cameco, is the top holding, and that's an area that, as he discussed, we continue to believe is going to be really important in powering the future of AI and the future, really more broadly, quite frankly, of automation. So I think Canada does have an important role to play.
That's amazing. Thanks again to everyone who submitted questions today. These were excellent. We still have more coming in, but we want to be respectful of your time, so we'll leave it there for now. And if we didn't get to your question, feel free to follow up with us directly. We're happy to continue the conversation, and we're social. And that's wraps up today's session. A big thank you to Scott and Alex for their insights. And thank you to all of you who joined us from across Canada, from coast to coast. We hope you're walking away with new ideas on how to approach AI, not just as a trend, but as a diversified, multi-layered investment opportunity. If you have any follow-up questions, don't hesitate to reach out. Thanks again, and we'll see you next time.